Hello. So after reporting earnings, it looks like Palantir is going to open at about 12.5 USD today. And this continues the normal trend that we are seeing lately, where all stocks that have to do with the tech industry are getting absolutely massacred here. Now we're going to take a look at Palantir, and I'm also going to create a free cash flow model, a discounted cash flow model really, in which we will examine what kind of price it makes sense to pay for Palantir today after this drop, because the current price appears to be $12.5. So the company has lost a lot of its value, almost 50% in the last year. And you will see that they have a not applicable P here that points to a company that is losing money really. But let's take a closer look at what's going on here. The shares outstanding of the company are sitting at 2 billion, increased from 1.6, 1.5 over here, 1.6 back in 2020 really, beginning of 2021 almost. And so the company has been massively diluting investors here. That's a pretty steep increase, like what, 15% or so in the outstanding shares of the company in like a year and a half or so. That's a lot. So the company tried to take advantage of the increasing stock price here. Let's take a look at the income statement of the company, see what's going on. You will see here that the company's revenues are increasing, and the gross profit growth also increasing year over year. And the net income, though, is in the negative. So the company is losing money from operations, and they're basically making money from debt and stockholders that are willing to purchase their shares. And that's problematic for a company, although you can kind of understand it from a company that's actually in its first few years of operations, and a new IPO can potentially do that for a while. Now, the total assets of the company and the total liabilities is the thing that we want to be seeing here. Total liability sitting at close to $1 billion, and the total equity at $2.2 billion. So the company has more equity than liabilities, which is obviously good. The cash flow statement points to a company that is losing money for the most part, but the last 12 months. So the last 12 months, the company is actually making positive operational cash flow here, which is a fairly important thing to see, especially from a company that was losing money for a while. And the important thing, though, the most important thing of all, is the free cash flow. So the company was losing free cash flow, was actually losing money year over year, but in the last 12 months actually made its first few million over here of free cash flow. So that's an important step towards profit really, towards profitability. The other thing that I want to quickly take a look at is the solvency ratings here, where you will see that the company's debt compared to equity is not much, so that's good to see. And also, the cash from investing points to a company that's investing a little bit in marketable securities, and also the cash from financing points to a company that gets a little bit of debt, as we saw earlier. Total debt issued here, 500 million and 200 million. That's not massive amounts of debt, of course. And issuance of common stock, they are getting a lot of their funds from investors willing to buy shares at higher valuations, as Palantir used to have at some point. Now, the next step that we want to take is examine the company's free cash flow and compare it to the actual market price and see what kind of price it makes sense for us to pay today. And so to do that, we're going to use a model that I have created, and this is a free cash flow. Actually, it's a discounted cash flow model. And you will notice that I have already copy-pasted the cash flows here in these fields, and we're using this to project into the future in the 10 years from now. And this is kind of skewed over here, the 5-year average free cash flow, because some values are negative, but it doesn't really matter because we don't really have a baseline to go with. Now, I've taken a look online, and a lot of analysts are pointing to 30% of free cash flow increase year over year for Palantir for the next 5 years or so, which I think is very optimistic, really. I won't go with that. I will still be a little bit optimistic, but I'm going to use 20% instead for the free cash flow growth. The discount rate that I want to get is a little bit more than 10% as usual. Make sure that I beat the S&P 500 fund. So I'm gonna go with 12% in this case, and a perpetual growth rate of 1%, which has to be low because we are projecting through perpetuity really, and we can never really beat the economy, the US economy, for example, which grows at like 2 or 3%. So 1% makes sense. Now the outstanding shares in million I have also added here. It's 2 billion currently, although we may be expecting Palantir to issue more in the future, especially if the price of the stock goes up. That's what we have seen historically. But if we use these values and project into the future, you will see the free cash flows over here, and then you will see them discounted back to today's values over here. That gives us a sum of the free cash flows, and if we add this to the terminal value, also discounted for today, we are getting a total value of almost 7 billion right now for Palantir. If we discount this value, this perpetual value, to today's value, and if we adjust it for outstanding shares, which is 2 billion, and do the division, we're getting that the price per share to pay today is $3.5 if we want to be making 12% on our money annually, with projected free cash flow growth of 20%. Now, if we really go with analyst estimates, which were 30%, we could actually pay 7% today in order to enjoy a 12% discount rate in the future, basically making 12% of our money. Now, some of you could say that we need to be discounting based on risk and use the WACC or things of that sort, and it makes sense in terms of accounting and financials. But it doesn't make a lot of sense in terms of us as retail investors, because if we're going to use a discount rate of, let's say, 6%, and then we can actually find a reason to buy at $20. The point is, why would we want to get 6% out of the stock? It's not like we're doing financial estimates for any company and we're calculating risk. We're not like bankers, for example. We're retailers, we're retail investors, and we want to be making a specific amount of money from our investments. And so if we can make 13 or 14% from other investments, why go with that just to apply a discount rate of 6%, just because of it being a riskier investment? If it's riskier and we don't get enough money for an investment, we can move on to the next one. It's no big deal. So this is why I'm not really negotiating using like a 12% value here. This is always going to be like 12 to 13% in my projections, because it doesn't really make sense otherwise. So with this 12% and 30% growth, we're getting at a $7 valuation, and currently we're going to be sitting at least at 12.5, which is about like 80% more, something of that sort. So we'd like to have a steep decrease, a steep discount in order to enter Palantir. And I think I would be comfortable maybe entering Palantir maybe at $7 or $7.50. I think it would be an interesting time to revisit if it ever reaches that valuation, which I think it could, frankly. So hopefully that video helped you a little bit, gave you some information about the company and the cash flow it's making and how to project it into the future. And if you did like the video, please leave a like. That really helps the channel and helps me actually bring this video to other investors and people who are interested in this kind of content. So I'd really be grateful if you could leave a like. And if you enjoy this kind of content, please subscribe as well. You can also visit our Discord channel, and we talk about all sorts of things about investing. And we'd love to see you there. And in the meantime, take a look at this video that I made earlier, and it discusses NVIDIA in its latest earnings report, which, although it was awesome, company seems to be heading downwards. Thank you for watching this one, and I'll see you soon. Bye bye.